Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Welcome to the Liquidity Event. I am your host, Shane Mason.
I'm Kody Sherlund.
Glad to have you, Kody. And this is episode 176, being recorded on February 11th, airing February 12th, or just before Valentine's, St. Valentino's Day. Email us your financial questions at liquidityevent@brooklynfi.com, and we will answer them live on the air. Kody, we've got AJ is on her way back to sunny California after an IRL event that we had last night in New York City. So thank you for joining us today. Where does this podcast find you?
Oh, Minneapolis. Yep.
There's nothing going on there, huh?
No. Well, we're getting a little bit of a spring thaw right now. It's going to be like 35 degrees. It's going to be 50 by Friday. So ice is receding in more ways than one.
Ice receding from Minneapolis?
I think so. Yeah, time will tell.
Sorry, that was a political joke. I appreciate it. Glad to have you. Kody, you know I like to jab on the podcast, keep people on their toes. It's not fair. It's not nice. This is my 180th time doing this, and this is your second time, I believe, right?
Yeah.
Do you want to do a little introduction to the audience to your background, just so that we have some context for the co-host today?
Yeah, totally. I'm a senior financial planner here at Brooklyn FI. I've been here going on 3 years. Been a financial planner for about 10. Yeah, I mean, I work with a bunch of our clients here at Brooklyn FI doing equity comp, full financial planning. I am talking to people on camera all day, so
right on.
This is just fine.
Right on.
Yeah.
Tell us about you personally. I know that you're a golfer.
Yeah. This time of year, it's a lot more hockey than golf.
Yes.
Yeah, man. I'm dug into the Winter Olympics right now. I'm completely committed to watching NBC and not thinking too hard about what that means. So, yeah. I mean, hockey, curling. We got a lot of Minnesotans in the Olympics. So
hell yeah! I just saw one of our curlers is also a lawyer, and he's from Minneapolis. Is that right?
Yeah. There was also mixed doubles. The U.S. won silver. Sorry if anybody has been waiting over 24 hours to watch that match on Peacock. Yeah, they're from Duluth. One of them's a real estate agent. One of them, I think, is she's a lab tech. She's the first American woman to ever win a curling medal, which is pretty sweet. But yeah, there's some good curling clubs here in St. Paul and Duluth. So
very cool. I do feel like that is one of the sports. We have an article coming up about somebody that has two jobs in both the sporting and the legal world as well. So excited to get into that. But it seems like curling and the Winter Olympics are the sports where most Americans feel like they can truly just pick it up and get a bronze medal if they just tried. Right?
Yeah,
is that the vibe?
It crossed my mind a couple days ago. You know what?
There we go.
Drop every other hobby? Do I just do curling 5 days a week? It's honestly been a weird week for me to watch curling because I strained my adductor, commonly known as the groin, and so
thanks for keeping it PG on the Liquidity Event.
Watching them push off the hack and get really low and deep into that stride has been a little uncomfortable.
Hell yeah. Right on. Okay, well, let's get into the article. Yeah, I can't do frequent listeners of the podcast will know that which are very few people, will know that I can't do anything Olympiad. But you, Kody, I've seen you do some incredible sporting achievements, and I've heard about them. So I think that you could pop out to Milano and get down the mountain at least. So better than some of our.
Jack of all trades, master of none.
There it is. We do have some fun articles this week. We've got an IRS agent, as I said, that is earning his stripes as an NFL referee. So the classic American two-job haver, well, one of them does not offer health insurance. We'll dig into that. The kid isn't going to college. What do we do with that 529 plan? Article from Barron's on what we do with overfunded 529s and some financial planning topics to cover there. It's time to rethink the standard investment advice, but not too much. A wishy-washy take on this week's markets from the New York Times. Is it really a good sign when executives buy their own stock? We ran the numbers. An article from the Wall Street Journal on insider trading, not the negative kind, but the pre-forecasted kind, and how that impacts the stock. Anthropic plans employee tender offer at $300 billion valuation. So very BKFI liquidity event focused articles today. We also have a first-time home buyer question on the on Reddit's personal finance forum. So let's start off with this IRS agent earning his stripes as an NFL referee. Kody, this is a classic American take on what it takes to get by in America. We've got an IRS agent holding down two jobs. One doesn't offer health insurance. That is the NFL job, which apparently all NFL referees, there's some fun takeaways in this article. I didn't know that all NFL referees are considered part-time, even though they're traveling for 17, 18 games per year, and they don't offer health insurance, even though they pay them well over $200K. It's kind of sad that IRS agents have to hold two jobs. What was your take on this article? What are some fun stuff in here?
Yeah. I mean, it's also classic American is wondering if anyone works at the IRS, and well, we
Exactly.
found at least one. Yeah.
Yeah.
I hear about this every once in a while watching football, or maybe an NFL ref also decides to do a college basketball game or something, and they're like, oh yeah, this guy's an attorney. Like, oh, so he just really doesn't want to be liked by people. Like, so honestly, like it makes sense just with the NFL at least, because they only do 17 regular season games a year. I guess it's 18 weeks, but yeah, I
Yeah.
mean they with other sports, I wonder. Baseball referees. I mean, or baseball umpires. I think they're full time, but with the NFL, I mean, let's be honest, they just have a total and complete hold on doing things in the world the way that they want to do them. And a couple guys that are on 1099, like making a couple hundred grand a year, they don't even notice that. So,
Yeah. Yeah, I thought it was funny that I think it was cool that the IRS supports this person's side gig. I feel like the government should be or is typically a little bit more restrictive on what you can do outside of work, but apparently you can work at the IRS, which is potentially a seasonal job as well. But I think this guy's a criminal investigator. He might be one of those IRS agents that they issue a gun to. So the guy's got whistles, he's got guns, he's got flags, he's got stripes. Guy likes law enforcement. He likes enforcement of his own flavor. I thought one of the interesting things is you can only apparently be picked to be. He was a referee for the Super Bowl that we just had, which was one of the most boring Super Bowls that I can remember. What was your take on the Super Bowl,
I
Kody?
mean, one of the better. I mean, the Super Bowl wasn't super compelling from I'm not sure who's going to win standpoint,
Ah,
but
yes,
honestly, at least the refs didn't make a ton of calls, so
yeah.
everyone knew the Patriots deserved to lose. I mean, they got thumped.
It is hard to watch the Patriots be in the Super Bowl again until they
Yeah,
are losing by
it's
over
too soon.
20. Yeah. Yeah, come on, guys. Come on, guys. A lot of AI ads in that Super Bowl, really
Mhm.
swarming the airwaves, the AI ads, the Claudes, the Open AIs, etc. Yeah, but it was interesting that they really pick these referees just based on how good they are. So there's like an to be in the Super Bowl, I guess they get a bonus to referee the Super Bowl. And this guy has been picked every year that's possible. And the restrictions on being a Super Bowl referee are that you have to have been in the NFL for over 5 years, and you can only do it every other year. And then you have to be chosen by like the Uber refs or the proto refs, the supervisory refs, to make it to the big game. I guess you just have to not suck as a ref. I don't know.
Yeah, I mean, I'm here for the better refs getting more games. It's like, all right, you get more calls right, then you get to do the big game, and hopefully people don't notice you messing up, marring the
Yeah,
big game.
yeah. Cool. Well, speaking of education and I don't have a good segue for this. We have an article here for 529 plans from Barron's on whether or not what we do when we overfund our 529s. So 529 plans are intended for kids or adults. I guess they're adults in a lot of cases to go to college. I personally have a 529 just in case, even though I do not have any kids. And what do we do if we overfund those things? I think it's really fun when you realize that there are a lot of options available to you, and we should not be terrified of putting too much money into these 529s because they're really not designed to be especially to penalize you very heavily if you put too much money into them and set them aside for noble causes such as education. Kody, what is your take on overfunding of 529, whether it's too much money or the kid just decides not to use it for college?
Yeah, it's not the end of the world at all. I mean, there's a lot of options. So, I mean, this money is going to keep growing tax deferred and then hopefully get withdrawn tax free somewhere, somehow, kind of like a Roth IRA. A few years ago, we had a change where you could actually roll extra 529 money into a Roth IRA. It's got to be 15 years down the line. The initial limit was $35,000. That's just 5 years of basically backdoor Roth contributions in a row. So that's pretty sweet for your kid if they graduate from college, maybe they use 85% of that thing and then boom, they've got a Roth IRA. But even if that's not what ends up happening, you can transfer 529s. You can change beneficiaries. So you're basically just doing a rollover between family members. It could be siblings, could be cousins, it can be multi-generational. So there's honestly a lot of room. And with that $35,000 Roth flip, down the line. I mean, that could be a ways down the line for some folks, but I feel like that's going to be a different number in the future. That's just the initial rule that they whipped up a couple of years ago. And guess who makes the rules? Congress. Guess who has a bunch of 529 plans for a bunch of their grandkids that probably have too much money in them? A bunch of people in Congress. They're probably going to change this. It's gonna go up. I don't know when. I don't know how much, but I'd be surprised. So.
Yeah, I'm with you on that. I think that you take care of your own, and 529s are really for middle income or upper middle class Americans. Remember when Barack tried to get rid of the 529 and everyone was up in arms? And I was like, at first I even cocked my head. I was like, why are we getting rid of these college funding plans? And then you come to find out it's a tax loophole, essentially, or tax avoidance mechanism for people that have so much money that they can just fully fund college education 18 years in advance. And it's a way for them to get tax deferral on it. So it really only helps out the people that don't need help in America, where we have the highest wealth inequality in 60 years. So
you could super fund those things like 80K at a time. You can get like $400,000 into a 529 pretty quick. A lot of states let you go up to 400 or 500K, and
just let it rock.
That's just a huge vehicle. Yeah.
Yeah. And then, I didn't actually publish the blog post because it required a bit more scientific evidence than I was willing to put into it, but a little bit like more work, and I'm a lazy guy. So, but if you add, even if the kid doesn't go to college and you have to face that 10% penalty and the income taxes on the distributions, because it was able to balloon over the course of 20, 30 years, as long as you're getting a good return on that money, you're going to come out ahead. You keep it invested, even if you pay the income tax and the ordinary, and the gains on it, you're going to end up with more than just a regular brokerage account with all that tax drag. You need enough returns and enough time to justify all of that, but you can run the numbers with your financial advisor and figure out what that number is. So, good idea if you have the money and you've already maxed out 401ks, I guess Trump accounts, the Trump accounts that are available now, and all the other accounts, HSAs if you have access. The 529 is just another vehicle to defer taxes and minimize tax drag. All right. Speaking of investing, we have an article from the New York Times, the weekly column from Jeff Sommelier. It's time to rethink the standard investment advice, but not too much. The article is just trying to, this guy's got to write weekly about where we are in the markets, which is not an enviable job. I could not do that personally. I think I would beat my head against the wall. But it's questioning the 60-40 portfolio, given where we are with Silver and gold prices fluctuating so much, given the over-indexing of American stocks as compared to the worldwide stage. Should we essentially move away from a broad-based index of stocks? So should we move away from the market, maybe choose a different portfolio allocation? Just questioning our readers' historical advice of do nothing, let the markets do what they will, and that should work out for you. Kody, as a financial planner at BKFI, what was your take on the let's move
I
away
wanted
from
to
what's worked?
I wanted to take this from two different lenses: the
Let's see
financial
it.
planner and then the pundit. The pundit one's fun.
Mhm.
Uh, as a financial planner, I mean, one of the biggest pieces of guidance that I can give you is that you need to be well diversified in your portfolio. Like all that long term money that you're sticking away into stocks and bonds. If right now just the S&P 500 isn't going to cut. That's not diversified enough from my standpoint. Like 35% of the S&P 500 or so, you give or take a few percentage points by the day. That's just Mag 7. And like 40% of the American stock market just tied up in 10 companies. That's not you're not you could get more diversified that. Like you need to own small cap stocks, international, emerging markets. You probably need a little bit in the way of bonds too. Yeah, so like as far as the broad asset mix goes, like maybe we tweak our models by a couple percentage points here and there, but as gold and silver pop up and down, we're not radically rethinking the world week after week. If we were, then well, that would be a problem. And yeah, if I had to write a blog post every week, I don't know if I could control the snark. I get so sarcastic that people would accidentally probably do the wrong thing, and well, licensing would be an issue at that point.
Yeah, I can
And
see you
from
struggling with
another,
that.
yeah, and from another perspective, like, okay, how are we actually thinking about all the headwinds that are coming in right now? Like we've got some really spotty government data from the last couple months. Like October was a mess. Month over month and year over year changes were like the the federal government actually had to just basically say, hey, we're slightly changing our methodology because the math doesn't work without the data. So we think inflation was this. Uh, Things like that. And then, we've got a new Fed chair nomination, Kevin Warsh. We actually kind of, we don't totally know what we're going to get out of that. One perspective is that he's only one of 12 seats on the board. So he can't change the world just with the flip of his wrist. But, we also don't know that he's going to be like a total sycophant. He's not an academic like Bernanke, so he doesn't actually have tons and tons of published information about what he's going to be thinking in there. But the bond market seemed to relax a little bit with that announcement. So anyway, back to the point of like all these headwinds and thinking, oh gosh, should we rethink the way we're doing things? Like, the song "We Didn't Start the Fire" by Billy Joel.
Of course, yeah.
So Fall Out Boy rewrote the lyrics a handful of years ago.
All
We could
right.
probably just
All
do it
right.
again, right? We could rewrite that song and just fill it up like several verses, which is okay. What's happened since 2020? But
Oh, buddy.
the point is, like, there's always something going on that's just going to scare the shit out of people, and markets tend to be pretty resilient in the long term. So, like, even if we're concerned about X, Y, and Z, then like maybe there will be some short-term volatility. Volatility will always rear its head. We just need to be aware of that as part of our core set of assumptions that things are going to hop around in the short run, but if you want to catch those long-term waves, you got to be willing to dip and bob and go up in the long run.
Right. Right. I love this quote here that he had. I love that take on it, first of all, but I also love this quote. I happen to believe that the market is frequently wrong. So Mr. Summers thinks that there are idiosyncrasies that he can take advantage of. Short-term stock prices are often out of whack with economic fundamentals, and these discrepancies can persist over long periods. So, are we picking stocks? Kody, do you think that Mr. Summers is?
You know what? Like the market does move around a lot, so maybe you could say
Hmm?
not wrong just early, but or sometimes it ends up being wrong. But I don't really want to pick stocks and try to figure out where the inefficiencies in market knowledge are. When you've got a lot of people aggregating information, you can, one, have a lot more information than you as one person could possibly process. And two, there might be a little bit of group there. So you're going to have to find a way to thread that needle. And I don't think shorting the market on the whole is the best idea, just because there's a pretty high chance that it screws you a lot personally. Yeah,
Yeah, I mean,
I don't know that I would ride that double-edged sword.
right? I mean, what's the quote? You can be right, but can you be right longer than the market is irrational, right? Like, can you ride
Yeah,
out those
can you
waves?
remain solvent longer than the market can remain irrational?
Thank you.
Yeah,
Yeah, I knew it was in
the
there.
answer is almost always no.
Yeah,
Even
yeah. Can
Elon
you
is probably
be
wondering that for himself.
right? And Mr. Burry, who stepped away from the markets earlier this year, late last year, has had enough, I believe. Cool. All right. Well, speaking of markets, we've got this lovely article about insider trades happening within the market. Not necessarily negative ones, but we have a Wall Street Journal article looked at 1,400 insider stock purchases over 5 years to get an analysis of how those trades will either impact the stock or the stock will be impacted by those trades. And they found that only 15% of the time did the stock actually recover to where it was before the drop that triggered the buy. So this is CEOs, CFOs, CTOs buying stock after a dip and looking at the impact after those purchases. 2% median bounce in 30 days. Then it just fizzles. So the next time you see a headline that says a CEO buys $5 million in shares, you might not want to rearrange your portfolio. What was your take on this article from the journal, Kody?
Yeah, this is a good one. I like this. First and foremost, just to start from a 10,000-foot view,
Mm-hmm.
almost all executives are required to own company stock. Most of them, at publicly traded companies, most of them have to have like 3 to 5 times their annual salary in stock. So, if these guys are turning over their RSUs and their employee stock purchase plan, and it's like, okay, they have to have $1.5 million. Sometimes they need to go buy it. And it's a pretty natural human behavior to see if the stock price goes down. You know what? Now's probably a good time to get back into that position. That's it. Like the
Yeah.
numbers in this article were not surprising in the slightest. So 69% of those purchases were after a dip, and only 60% of those went up after that dip. And like you said, only 15% of them got back to where it was before the dip. Like
Yeah.
the
So it
center of
goes
the
up.
scatter plot was really close to the middle of the X and Y axes on this chart.
Yeah. I mean, I guess if you if you have to buy as an insider, you do want to buy after a dip. Unfortunately, only 60% of those go up after the purchase, and like as you said, only 15% actually fully recover after the purchase. So I guess a lot of these CEOs are buying and not making money. But there's
Yeah. Yeah, this was. I mean, it was interesting to look at the data. It's almost an article that felt like, all right, let's back up these C-suite guys and just like throw out there, hey, we've got a set of data with 1,400 transactions. See, everything's fine. So a little bit of a CYA, but also a little bit of a nothing burger all at the same time.
yeah, I mean, I guess it isn't nothing, but I guess it isn't. There's a couple other ways to look at it. Like you could see it as it's broadly announced whenever an insider makes a purchase or a sale. So you could consider it like a PR move with a brokerage account, like something punchy to like get people excited about the stock. If an insider, like there's a Tim Cook is on the board apparently at Nike, and Nike was going through it recently, and he purchased some stock, and then it bounced. If Tim Cook knows something, we should probably move with it. The details, the actual data points to in the opposite direction. But also, like if you're a client that is working at one of these companies and you have access to buying the stock, maybe you're probably already concentrated, like a lot of our clients are at BKFI. You might not want to trade based on what the executive team is doing because the data shows that it's you might be pulling a Jim Cramer. You might want to do the inverse actually, and invest in the inverse. Well, any other takes on insider trading?
Yeah. I mean, insider trading, there's a lot of shades of gray. Like,
Mhm.
you could be a restricted individual at your company and not be allowed to trade outside of trading windows. And it's like, okay, do you know more than the average person? Yeah, probably. But do you know enough to actually know how the stock is going to behave? How millions of investors are going to try to evaluate the value of a share of your company? No, you don't know how that's going to work. So I
Yeah,
think this is, at the end of the day, this is a point in the column of efficient markets having decent
exactly.
valuation.
That's what I was just thinking. Like circling back to like, can you remain solvent? Like you might think that the new product that's going to come out, Figma Make, for an example, like the AI ability to build wireframes, just as a silly example. I don't know if people actually believe that release is going to pump up the value of Figma, but we've seen Figma not do quite well after its IPO, and we all thought that Figma, it was going to be purchased for 20 billion from uh, by Adobe, and then after the IPO, it had a pop, but unfortunately, it just has not performed very well since its IPO. So a lot of people think that because they work at the company that they know more than the market does, and unfortunately, the market doesn't always reward your insider information, and it doesn't. There are things that impact the stock that are beyond your knowledge of what's going on inside the company, unfortunately. So. Cool. Well, speaking of big companies, private companies going public, we have a trend in that direction with Anthropic, which apparently is planning to offer a tender at $350 billion valuation. It's working on a deal to let some employees sell shares, which I think is super important for employee retention. This could bring in more than $20 billion for employees. What was your take, Kody, on this offer? It's like one of the highest private valuations of a company in history. It puts puts Anthropic at a valuation close to Salesforce, which has been public for
Yeah,
quite some time and is a tested, profitable company.
yeah. I mean, the first thing that came to mind for me is it was employee retention. Like, get you guys paid, get them a little bit of cash in their pockets, because right now, if you're, I mean, I hear more about people outside of Anthropic wanting to go to Anthropic than the other way around. So they're probably getting that memo too. But yeah, the valuation's huge. Like, I mean, Claude Code is sweet, and I mean, people are really excited about what they're building, and they don't have to IPO necessarily. I mean, they may eventually, but like, they're able to realize a little bit of liquidity right now. So I think it's good for the people working there without a doubt.
Yeah. So Kody, a client comes to you and says, I got the email, I can sell some of my shares. What's the first question you're asking this client? You can caveat that with I need to know more, like about this could be somebody that just landed on your plate at BKFI. What are you asking this person to get an idea of what their exposure, like concentration? Talk to me about that experience. This is something you
Yeah,
do
yeah.
on the daily, I'd say.
Yep, on the daily. Yep, and I have a decent idea of what it looks like for Anthropic too. So, I mean, the first
All
thing
right
that I
up.
would want to do if someone brand new walked in was basically be like, all right, let's hop into the stock plan here, take a look. Okay, you've got a bunch of RSUs, you've got some options. I need to figure out what those options are priced at, if they've exercised anything, or if they need to figure out where we're sitting on taxes, because every little piece of equity comp gets taxed differently. And at the end of the day, I want to maximize, well, not necessarily maximize, but I want to be efficient with what someone's take home is going to end up looking like out of this. So it, it depends on if we're looking at short-term capital gains or long-term capital gains, and sometimes spreading out those bets over time. Someone participating in this tender offer isn't going to be able to sell all of their stock. Like, so we have to figure out which shares we're going to go for. Eventually we may find out what the demand for that tender offer looks like. Sometimes they come in below, and sometimes they come in above, and you actually sell less than you wanted to. Especially when we see a huge pop. I saw this at another company just this last month, where everybody who tried to sell ended up only selling like 65% of what they wanted to. But they're still getting some extra cash in their pockets. But yeah, I mean, other than just trying to figure out the tax efficiency here, what are we going to do with that money? Like, just as a person, like, okay, is this a down payment for a house? Is this going into the 529 plan? Maybe not all of it.
Right?
Yeah, like,
Hopefully some of
are
it.
you, yeah, are you firmly in that Henry category, high earning, not rich yet, where you're making hundreds of thousands of dollars a year, and then you're feeling strained because you have $12,000 in cash at any point in time, and you're like, I don't know how my colleagues are buying houses right now. I can barely afford daycare. Like, just creating some financial independence and a little bit of ease of mind for those folks. Just like, all right, let's come up with a plan for an emergency fund and figure out our cash flow order of operations, frankly.
Right.
Because,
Love
if
it.
you're busy working at Anthropic, you might not be thinking a whole lot about financial planning. So,
Exactly. Yeah. I mean, there's just too many things to think about, right? There's estate
yeah.
planning, investment planning, tax planning, retirement planning, insurance planning, all of these things. I don't know why I need to put the suffix of planning on all of these highlights, but underneath each one of those umbrellas of planning, there are too many options to dig into. And maybe one day we will reach AGI and Claude will be able to answer a lot of these questions for you, but are you still going to be able to lean on suing Claude if something goes wrong? So yeah, we need a human in the loop, of course, assisted with our tools to answer these crazy questions for you. You can focus on doing what you do at Anthropic or whatever company that you are having a large individual contribution to or managing at. But we need to delegate these big family important decisions to somebody that does it for a living. So, speaking of where the money will land, we do have this Redditor question that I'd love to. Maybe this Anthropic tender offer is going to end up. Maybe this person asking this Redditor question works at Anthropic. Hi, my wife and I live in New York City. We're married. We're in our early 30s. We have a baby on the way. She's a stay-at-home mom. And will be a stay-at-home mom for the first few years. We're making $750, maybe $850 next year. We're sick of being crammed in a small apartment. We're looking at homes in the burbs. A house that can fit us and our small child and future babies, interesting, are generally 1.8 million. Oh, definitely a New York City problem. This is Rich People Personal Finance, by the way. Is a 12,000 subreddit. Is a $12,000 payment per month crazy, including tax and insurance, etc. We're going to spend 8 to 10K per month outside of housing. We would need to buy a car in this case. Our current rent in New York City, get this, $8,000. But none of the cost of rent in New York City will be $8,000, but none of the cost of home ownership either. So, Kody, should you be spending $10,000 a month on housing?
I mean, they can. Like
Yeah.
their level of income can support it from a
Yes.
pure blind ratio test. I
Yes.
think they could be more efficient than that. They don't have to do that. Yeah, I mean, one of the first questions that, like right now, housing is expensive, especially if you're buying instead of renting. And I mean, one of the biggest reasons for that is simply just a lack of supply and a lack of inventory, especially in like the East Coast and the Upper Midwest. Things are a little bit more relaxed in the South and the Mountain West, but yeah, I mean, if you want to buy a $1.8 million house in the New York suburbs, yeah, you're going to be staring down the barrel of like 12 grand a month, and that's a choice. So the first thing that I would ask this person, other than okay, let's do the math and see if this is financially possible, which it probably is if he keeps making that much a year, is do you want to spend the money on this? Do you want to live in this house for 10, 15 plus years? And is it something that you're going to actually derive enjoyment from? And, to someone, they may want to put down those roots and spend that money to have that neighborhood that they're going to grow old in. And like, that's return on enjoyment, not return on investment. Because if you're going for pure return on investment, this is a bad idea. Like, I would rent for half to 2/3 the cost and throw some money in a brokerage account every month. And then, hey, move to Minneapolis. $1.8 million goes a lot farther here than it does in Long Island. Or just buy the same house for 900K and be pretty
There you
happy.
go. Yeah. Yeah. Well, I have to agree with Redditor 12 Gauge, who asked the question. Great name. Are you leaving out your net worth on purpose, or are you new to this level of income? I think your net worth, of course, is an important thing to consider when making a purchase. If they have $10 million in a brokerage account already, then yeah, like whatever, go for it. This is a small percentage of your assets, but it seems like this might be potentially 100% of their assets would be in real estate in this case. I mean, I doubt that. I'm sure they have a 401k at work and they have some other assets that would help them diversify and that are risky assets. But yeah, it's hard to justify. I always do this on the podcast where I say I don't know the full picture because, of course, we haven't gone through a full 6-hour financial planning data collection process, but that's a cop out. I think that we need to know a little bit more, of course, but yeah, I mean, also how many babies are we going to have? If you rent, it's so much easier just to hire movers for a few $1,000s and get another house until you know how many babies you're going to be locked in for the next 10, 15 years, and you know much more about where your job is. I mean, what's going on with AI and everything. I hate to say that, but like the landscape of work has changed a lot over the past 5 years and will potentially change a lot over the next 5 years as well. So I think locking yourself into an extremely high cost of living area and an expensive house is tough to justify.
Yeah. Also, to your point about the potential for their entire net worth to be locked up in the value of their house. I mean, that
Yeah.
is one building on one parcel of land in one neighborhood. That's a concentrated bet. And guess what? Real estate's not necessarily the slam dunk that our grandparents always tell us that it is.
Yeah.
Like, oh, you should buy real estate. Well, in the long run, it tends to just pace with inflation. And
Yeah.
some goes up and some goes down. We don't need to talk about Austin, Texas, but yeah.
Hey, don't get me started on Austin real estate. Great. Well, I think that covers it this week. Kody, it's been a joy to have you back on the podcast. And to our audience, thank you so much for listening. You can email us your financial problems at the Liquidity Event at brooklynfi.com. And finally, you stands can leave us a review if you want to be weird about it. Thanks for coming. Take care.